Greetings. It is time for another monthly monetary creation report, one of the flagship monthly report series on this channel. And as always, we go to the Yardeni report and we scroll down to these balance sheets of the four major central banks of the world. Red is the United States Federal Reserve, blue is the ECB, and then the Bank of Japan and People's Bank of China. And you can see that all four of them have been printing money since about 2007, and the United States is only about 1/3 of all total money printing. At the moment it has the highest balance, but that was not always the case. The European Central Bank had a higher balance than the United States Central Bank for quite some time. It has only now gone a little bit lower, and these other two are also substantial. Many people who complain about money printing allegedly causing inflation seem to think that the United States is the only country that is printing money in the whole world, and that is entirely not true. The United States has contributed only a fraction of total world money printing. And since money printing is borderless and technological deflation is also borderless, only the grand total of the entire world matters. This takes us to our next chart over here. This is the sum total of the four major central banks that we saw above. Those four major central banks comprise 85 to 90% of all the world's money printing. Not all of it, but the vast majority of it. And as you can see, this broad trend line has always been of an exponential nature. Whenever they stop money printing, they have to do more just to catch up. Whether there was a COVID-19 crisis or not, this was already rising exponentially. And whenever they try to deprint like they're trying to do now, they have a crisis and have to print a little bit more. That already happened once. Now they're trying to deprint again. Guess what will happen again? And as you can see, this net growth of money printing, even from early 2018 to present, is not that much. It's only another $6 trillion in 5.5 years. That is nothing. As per the trend line, we should be over here by now. To intercept the trend line within a year or two, we will have to be over here above this chart. So $10 to $12 trillion more will be needed just to match the long-term trend line. Now, other suspicious things are going on because the supply of money, M2, is rising even as this deprinting is occurring. And so some of the data is contradicting each other. We'll wait one more month to see whether that sustains for another month before I draw attention to it. Maybe the central banks of the world have figured out how to print money without it appearing on the balance sheet, thereby appeasing the people who watch the balance sheet but still keeping money printing going. So as more months of data emerge, we will be able to detect if that is in fact the case. But as you can see right now, $27.1 trillion is the net amount of money printing, even though the last 1 month has had a deprinting of almost $1 trillion. It will be reverting back up because technological deflation is exponential, and this money printing gets ingested by technology, offsetting that technological deflation and producing more technology. That is, in fact, the virtuous cycle that keeps repeating but is beyond the economics establishment to figure out, even though I've been explaining this at length for quite a few years now. And now this next chart is the growth rate of the chart we just saw above, the year-over-year percentage annual growth rate. I claim this has to be between 16 to 24% to be at equilibrium with technological deflation. Only sometimes is it well into that zone. In February of 2021, because of the COVID-19 crisis, this reached an unusual high of 46.3%. That is a level at which even I thought there would be inflation because of the rate of growth of money printing, but the wave of inflation that arose was very brief indeed and certainly ended just as quickly as it began, as we will see in the second part of this video. Then deprinting began, and the year-over-year growth rate has been negative for quite some time. So it should be here, 16 to 24%, even the lower end of that range is 16%, and instead we see that it's at minus 8 or 9%. Just to get to 16 to 24%, again, we would have to do the same $10 trillion of money printing that we saw in the chart earlier to get us back to the trend line. So this is another way to look at it. What is the year-over-year growth rate to maintain that trend line gradient? And that is why so much money printing does not cause aberrantly high inflation. In fact, it is only offsetting technological deflation, which itself is exponential, thereby requiring exponential money printing. And now lastly, we go to this final chart, because a lot of people still seem to think that the United States is the only country in the world and that inflation of worldwide priced commodities such as gold is somehow governed by the US Federal Reserve printing money. This chart represents the percentage of each entity's GDP that the balance sheet represents. The ECB covers the entire Eurozone, so all countries that use the euro. And while GDP is an annual metric and this is a cumulative metric, it is still an apples-to-apples comparison across these four entities. And the United States Federal Reserve, the red line, is the joint lowest of the four. It has printed only 31.8% of its GDP, about the same as the People's Bank of China. Europe, the ECB, has done twice that much at its highest point, and even after this recent decline, it is still way, way more than the US Federal Reserve. Now, you would think Germans would be the people most afraid of money printing, but apparently not. They were quite happy to do twice as much as the United States did. But the highest number, of course, is Japan. They have done twice as much again. The Bank of Japan has done 128.7% of Japan's GDP in cumulative money printing, and even after this decline, it's rising again. Even the people who falsely claim that the US has very high inflation, those people don't claim Japan has high inflation. How could Japan do 4 times as much money printing in relation to the size of its economy as the United States? Well, again, money printing is borderless, and the money printing that Japan does comes into the United States and other parts of the world, and therefore only the grand total matters. But the purpose of this chart is to reveal how inaccurate it is to say that the US Federal Reserve has printed so much money and that's why we have hyperinflation. Number one, it hasn't printed much money at all relative to others. And number two, we don't have high inflation at all in the United States. Under no possible measurement that has any statistical validity or rigor can we say that the United States has structurally high inflation, as we'll see in part 2 of this video. So this was the monetary creation update for money printing, and as we could see, money is being deprinted right now. It's going down. The last 1 month was $1 trillion of deprinting, but there was a suspicious increase in the M2 money supply, and we will examine that in more detail next month if that disparity persists, because that could be an answer to some of the mysteries that exist in the economy and the stock market today. Why the stock market is not falling despite deprinting and an inverted yield curve. Maybe they're printing in an even more below the surface manner. But now, on the topic of inflation, we go to part 2 of this video. So as always, we have my 3-legged stool, the US CPI 10-year compound annual growth rate. You need the 10-year compound annual growth rate to smooth out flutters of high as well as low inflation and get some idea of long-term trends. Then the most important measurement of all, the GSCI, Goldman Sachs Commodity Index, 10-year compound annual growth rate, it is by far the most important measurement because it is comprised of freely traded items and it is worldwide. The two things that people object to in using the CPI, which is that it's US only and that it is a government published index, are both nullified by the Goldman Sachs Commodity Index because the price of oil is freely traded. The price of gold is freely traded. Natural gas, silver, everything. This is by far the most holistic, most important, and most comprehensive measurement of inflation. And then the 10-year US Treasury yield, which is more in anticipation of future inflation but has a tremendous effect on rents, mortgage payment prices, and housing prices. And I need all 3 of these to be above 3% before I say that structural inflation is high. If only one is above 3% and the other 2 are not, that does not mean inflation is high. And remember, this is optimal inflation. Being at 3.1 is not some disaster. That just means it is 0.1% above optimal. Then hiring is sluggish, as well as price earnings ratios on the S&P 500. Real estate price gains, home equity gains, net worth, everything is bad when inflation gets too low and we slip into deflation. I've explained many times why deflation is bad on this channel. You can search for multiple videos about that on this channel. And so let's look at each of these 3 to see what they are today, July 16th, 2023. 10-year US Treasury yield, 3.82%. This one is above 3%, but it has been for several months. And it cannot really break above 4%. It is suspended in this zone of the high 3s, but still a 3 handle, which is a way of saying that it's still 3 point something. It is not 4 point something. So this one is above 3%, and this is exerting negative pressure on both the US housing market, as well as the amount of interest that the US federal government pays on the national debt. And I've talked about that in other videos, but this is 3.82%. Now the Goldman Sachs Commodity Index, Goldman Sachs Commodity Index 10-year compound annual growth rate, as signified by pressing this button for 10 years, minus 1.35%. It is in deflation over the last 10 years, partly because of oil, partly because of gold. Oil is cheaper than 10 years ago. Gold is the same price as 10 years ago, contrary to what gold bugs will admit to. Deflation for the most comprehensive index. Again, it is comprised of freely traded items, so it is not riggable, and it accounts for the worldwide price. So if the dollar is strong, dollar is weak, all those factors are canceled out because this is comprised of things traded worldwide. It is a very comprehensive index, and it is in deflation. Now we go to the US CPI. This is from the bls.gov website, and every month I do this video, I have to make a decision about whether I want to explain this methodology in detail for first-timers or if long-time viewers are going to get bored. So I'm going to make a decision this time to not explain everything in too much detail, refer to prior month videos for that. But this is the CPI number over here. And the 10-year compound annual growth rate is calculated by taking this most recent number, 304, and dividing it by the number exactly 10 years ago, which is 233, and taking the 10th root of that. And I'll show you a table that tells you what all those things are. And this is the 1-year amount of movement. As you can see, there was a flurry that was higher, which is now long in the past, more than a year in the past. The same goes for the 2-month inflation moving average, the 3-month inflation moving average, the 6-month inflation moving average, and now even the 12-month inflation moving average. This rose up and people became hysterical because of framing lumber and eggs and a couple other things, and it fell just as fast and is still falling. And it was going to fall anyway without Federal Reserve tightening, but that is why this was really a non-event in the grand scheme of things. In the history of the US economy and the world economy, this was not a big deal at all. Now, to take all those graphs into our familiar table to make it easier to look at, so here you see this table, and the function of this table is to take all those varying time windows and annualize them as though they were all stretched to a 1-year window as their rate, which is to say, what if the inflation of the last 1 month, what is 12 times that compounded to get an annual rate? So for 1 month to the 12th power is what it has to be. For 2 months to the 6th power, for 3 months to the 4th power, 6 months to the 2nd power is square, 1 year straight, 3.1% as we can see. And then 2 years is the reverse. Square root, cube root, 5th root, and 10th root. And as we can see, the annual CPI gain for everything up to even 1 year is at a very low zone, 3.1% over the last 1 year. I've had a lot of agitators come over when this number was temporarily high at 8%, and they said, only the 1-year window matters, 10-year window doesn't matter. But those people are nowhere to be found because they're very intellectually dishonest and they're desperate to be knowledgeable about an impressive sounding subject, but they're not up to the task, sad to say. 3.1% over the last 1 year, and all the recent months are low. That bulge that we saw in the CPI is now in the 2-year and 3-year windows, higher than normal certainly, but it's in the past because it's more than 12 months away. And the number that's important, I consistently stay on this, as all long-time viewers know, is the 10-year average inflation rate, which is 2.7%. 10 years is what matters because these short-term windows are always volatile. There's a lot of noise, even at the 1-year level. But for those who think 1 year is important, fine, it's now 3.1%. It's not going to rise anymore. It only rose because of the Russia-Ukraine war pushing oil prices high for a short while. That is more than 1 year ago, and oil prices have come back down somewhat and still have further to fall. But 2.7% is what matters. When this is above 3%, then I'll say yes, CPI inflation is slightly higher than optimal. So we go back to my matrix. So we saw all three, 10-year compound annual growth rate of the US CPI, 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and 10-year US Treasury yield. And the answers were 2.7% for the US CPI, so below 3%, minus 1.35% for the Goldman Sachs Commodity Index. This is pretty volatile. It could go back above 3% in theory in a very short time, but that does not seem to be happening unless you think gold is going to rise by a lot and oil is also going to rise by a lot. So this is in deflation, the most important of the three. And the 10-year US Treasury yield is 3.82%. This one is above 3% and exerting downward pressure on housing prices. Keep that in mind. But only one of these three is above 3%. I say money should be printed, quantitative easing, to the point that all of these three are at or near 3%. That is what the optimal policy should be. The nature of money printing should also change, as I explain elsewhere on this channel. But This is where inflation is right now. I've taken a very data-centric approach. No anecdotes, no emotional need to push a narrative or anything like that. And I've been very consistent because there's a lot of archives of this monthly video series. And no, inflation is not high. I don't care what anyone says, because everyone who says that it's high is not using a data-based argument. The type of arguments that they use, I rebut in this video in the upper right-hand corner, Kartik's law of inflation. So if you're not familiar with that, you may want to go look at that. But if you found this type of content to be informative and this data-driven approach to be enlightening and helpful in your quest to cut through the media narrative, because the business model of the media is pessimism, of course, then I encourage you to subscribe to this channel, and thank you very much for watching.